Welcome back to the Money Catalyst. This is Grow Up and Manage Your Money Part 2. If you are just joining us on this Grow lifestyle, you will want to listen to Part 1 before listening to this Part 2. The link is below in the description or at the top corner. Don't worry, I'll wait. This is part of your Grow Up experience. Now, let's move on to number 3. Number 3, if you're in any form of debt, make it a priority to settle it as quickly as you can. It often seems difficult to manage money because there are tons of competing priorities. Having just one focus helps. Sam Beckbessinger says if you currently have any debt, the best thing to do is get rid of it first, no matter what your other priorities are. Debt can be a burden as it requires you to use your spare money to pay for things you have already purchased in the past instead of using that money to invest in your future. It can become a trap that progressively worsens, limiting your options to the bare minimum. According to the law of compounding, here is an illustration of how your debt could be growing out of proportion. Credit cards, 22%. Store loans like Target Card in your wallet right now, 22%. Overdraft fees, 23%. Microloans, 89%. Now compare the above data to how much interest savings and good investments can bring in for you. Savings, 6%. Lucrative share portfolio, 14%. So make it a priority to kill off your debt. But don't feel bad about the debt. Almost everyone in the world has been in this situation at some point in life. The whole financial services and advertising industries are set up to trap people in debt forever. Just do the best you can to get out of it so you can start living your life on your own terms. The way to get out of debt is to cut down your expenses to the minimum and pay off the debt as quickly as you can. If you have more than one debt, Sam Beckbessinger recommends using a strategy she calls the avalanche method. Here is how to go about it. Make a list of your debts from the highest interest rate to the lowest. First, pay off the debt with the highest interest. Once the most expensive debt is off the list, take the full amount you were paying on it and put it all into paying off the next biggest one. If you recall the principles of compound interest, you'll know that this is the most rational way to pay off debt as it can help you save a lot of money. Number 2, your age should determine your risk tolerance in terms of investments. As you are well aware now, diversification is essential if you want to grow your money and keep it safe through tactful investments. The good news is that you don't need to worry about building a complex portfolio that comprises over 400 shares and some gold bars hidden in your closet. There are simple investing funds that are already diversified for you. We'll take a closer look at one of those in the coming chapter, as there is something you need to know about risk first. If you are under 50, you can have a considerable amount of risky investments in your portfolio. According to Sam Beckbessinger, most of your assets should be held in equities if you are younger than 35. Generally, stocks are high-risk, high-reward assets. Therefore, the more time you have to invest, the higher risk you should be taking. You are young, so you've got the time factor as an edge. In the long term, equities are the best performing asset. So this is the smartest way to grow your money. Of course, the risk we're referring to here doesn't mean risk in the technical sense, like pumping your money into shady investments. As you grow older, you'll want to start phasing lower risk investments like bonds into your portfolio as well. One of the rules of thumb investors use for this is called the 120 rule. Subtract your current age from 120. That's the percentage of your portfolio that should be in stocks and equities. So if you're 30 years old, for instance, 90% of your assets should be in stocks. If you are 50, that would be 70% of your portfolio in stocks. An intelligent investment choice you can make is to establish an automatic debit order that transfers a fixed amount of money into your investing account every month on the day you receive your salary. You don't have to exhaust yourself by constantly deciding how much to spend and how much to save. You can benefit greatly by arranging an automated payment to ensure you save as soon as you get paid. Also, make sure you stick to a simple, low-cost investing strategy. Make sure you understand what you're investing in. Find a single fund that is already as diversified as possible with the right level of risk for your age. Don't try to beat the markets. Focus on reducing your costs. Number 1, investing in low-fee ETFs helps you leverage the full power of diversification. So you're just starting out as an investor, and you need a single fund that is already as diversified as possible with minimal risk. Meet the low-fee global index ETF. The ETF, Exchange Traded Fund, works like any other company listed on the stock market. Just as you would buy and sell shares in a regular company's stocks, you can do the same for an index ETF. But one cool thing about this asset class is that it's like you're essentially buying the entire market. The fund tracks the index, which is like the overall performance of all the companies in the market. That is, if the whole stock market goes up by 5%, then the fund goes up by about 2%. It's just like you bought shares in all the companies listed on the market, except you don't have to keep hundreds of stocks in your portfolio and monitor them separately. All you do is hold the entire market by buying shares in a single fund. This is one of the best strategies for all investors, regulars, and beginners alike. By following this simple strategy, your chances of doing well in the markets are significantly higher than those with fancy investment portfolios trading on exotic platforms. This is not to say that the strategy is the holy grail or that it will help you get rich quickly, but it's definitely an approach that will make you the most money over your lifetime. So Sam Beckbessinger strongly recommends that you check this financial product, ETF, out. To fully capitalize on the benefits of diversification, you should also make sure that a considerable portion of your investments is global. This lowers your overall risk even more. Investing in foreign assets protects you when your country's economy goes through tough periods. Regardless of your nationality, global funds give you the opportunity to invest in the most successful businesses in the world. Think of industry giants like Samsung, Google, Amazon, Apple, Toyota, and Tesla. You can own a piece of each of them. Some common global indexes you can check out include the MSCI World Index, the MSCI All Country World Index, the FTSE Global All Cap Index, and the S&P Global 1200. In conclusion, in our society today, we have tons of choices vying for our attention. If we want to take total control of our finances, we have to be more deliberate about how we make those choices. People who aren't deliberate about their choices spend every cent they make on other people's ideas of what makes a good life. You're smarter than that. Don't let yourself be turned into a consumer or a wage slave. Start managing your money like a grown-up by figuring out what matters to you. Once you know what you want, you can then start spending your money in line with it. Don't try to look rich when you're not. That's how most people end up poor. The wealthy teach their children to live frugally until they can afford their real lifestyles. They are allergic to car loans and credit cards. Debt makes your job mandatory. Saving is freedom. Sam Beckbessinger. The beautiful thing about money is that the more of it you have, the more time you have to spend doing the things you love and being with the people you care about. No one lives forever, so being rich in the currency of time is absolutely essential. Taking control of your finances can give you the freedom to live life on your own terms. It's not just the people who desire luxurious things that need to care about money. It's everyone who wants to achieve financial independence, break free from the daily grind, and eliminate the fear of losing their jobs. Try this. Start managing your money like a grown-up now. Don't tell yourself you'll wait till you're older before you start figuring things out. The law of compounding states that the financial choices you make now while you're young will have a much more significant impact on your life than the choices you make later. You must start right now. If your expenses are currently eating up all your income, try to cut back on the spending. If you're currently in debt, use the strategies we discussed in this summary to get yourself out of it. Make sure a fixed percentage of your income goes into your investment portfolio regularly. That is how you get ahead. It's important to try this out to better understand yourself and manage your finances effectively. Check out the video in the top right corner that explains more about how to manage your money. We know you really love this material, so smash the like button of this video, subscribe, and turn on your notifications. Your support will help us stay on YouTube and continue providing you with quality money tips. And again, this is part of your grow-up journey. Yes, we hear you and you are welcome.